So my journey into the markets actually began with one of those options trading courses that you see advertised. This was so long ago, and honestly it was a bad way to start, simply because it's one of those situations where they give you a kind of a system but they don't fully explain it, so you have no idea what's going on. The only benefit I'd say is after that it sent me on this journey of wanting to know more, so I really devoured dozens and dozens of books all about trading and technical analysis. The long story short is that, hey, I tried to become an active trader for years and I failed because after a long series of trial and error, I realized that I'm just not cut out for that kind of level of trading on an emotional level. I've now evolved to become a more long-term investor, but at this point I still use technical analysis tools that I do believe help me in my decision making. That's why today I'll share with you the tools that I still use to make the occasional trade that I do, and I'll have an example even at the end to walk you through what it looks like. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest and feel better about money. The first tool is multiple moving averages. And the off chance that you haven't heard of moving averages or MA, it is simply the average price over a defined period that they have calculated and they're plotting it in the chart. I use 3 separate periods, which are the 20-day for short term, 50-day for medium term, and 200-day for long term. So here's what I pay attention to with these indicators. If all 3 moving averages are trending in the right direction, one over the other, it simply means that the trend is clear in one direction. The second thing is I pay attention to how prices are reacting to some of these moving averages. This tells me whether or not those moving average levels are acting as strong support levels or resistance levels. The final thing is I pay attention to where is the current price relative to the short-term moving average. And specifically, I want to see that prices are not too far from it, because it is a red flag to me if prices are running too far away from a short-term moving average. The next tool that I use is the Relative Strength Index, or RSI. This indicator measures the strength or the momentum behind the price. And what it does is it calculates the speed as well as the change of the price during a defined period. It's also what is known as an oscillator, which simply means that there is an upper and lower threshold that the RSI tends to function in. And these thresholds tell you whether or not the movement could be exhausted. So here's what I pay attention to with the RSI. If prices are in a clear trend, whether upward or downward, I tend to pay attention to extreme levels of RSI, which in my view sometimes can signal a short-term reversal. And based off that extreme move, I might decide to whether trim my position or get out of the position entirely. The second point is related, where I usually will not initiate a position if the RSI levels are at those extreme points. It's simply because it's a little bit of higher risk. The other thing I look out for is what is called a divergence in the RSI levels. So what you want to look for is that if prices are making new highs, but the RSI levels are not, it tells you that the momentum behind that new high price isn't very strong. It's not a major red flag, but it is a bit of a warning sign that the strength of the move has begun to fade. The last tool isn't really an indicator, but it's simply price levels. On a chart, of course you got prices, but if you are familiar with just drawing very simple trend lines, you would usually see prices tend to react to any of those lines or price levels. So the first thing I pay attention to is that the more prices tend to react to those levels, the stronger that level is, whether it's a support or a resistance level. The second thing that I tend to keep at the back of my head is that when prices do eventually break out of those levels, oftentimes those levels can become the opposite thing. So what was once support can become resistance, and vice versa. Third thing is that just because prices break out of a level, it does not automatically mean it's a surefire move. and I've been plenty burned where it breaks out and then it reverses. However, if prices break out of a level, then they retrace a bit and bounce off it and then they continue back up, it basically makes the move a legit one. I think price levels are probably one of the most important for me because I use it to determine my entry points as well as potentially where to add my stops. And that leads me to my next important concept called position sizing. Now, this isn't really technical analysis per se, but it is absolutely essential, and I use technical analysis to help me do it. Position sizing answers the question of how big should my trade be or how much should I buy? A popular principle that many traders use is that you should only risk a maximum of 2% of your entire portfolio on a single trade. So say your account size is $100,000. Therefore, your maximum risk should be $2,000 for a single trade. Let's use the Facebook stock, or Meta if you prefer, to illustrate how I would use position sizing combined with some price levels to give you that position size. And as you can see from the chart, there is a nice price support level, but it's also verified by a 200-day moving average. Prices cracked down, but it looked like it made a reversal. And as I'm writing the script, it's currently priced at 332. Say that I'm bullish and I want to make a trade, and I determine that, hey, at the 310 level would be a nice place to set a stop to determine whether or not the trade has gone in my direction. Now here's where a little bit of math comes in. So as you can tell, the price difference between 332 and 310 is $22. It means that I can afford to buy 91 shares for this particular trade. So please don't take this as a trade recommendation. It's just here as an example to show you how I would use price levels to do position sizing. Now the final concept that I want to share is related to what I brought up in the Facebook example, which is I will want to use multiple points of confirmation, because my personal preference is to have a macro idea and then I layer on technical analysis for multiple confirmations. Now let me walk you through the thinking process of a specific trade that I made earlier this year. So starting from late last year, the backdrop macro view was already beginning to discuss the point of inflation. As a result, there were a few different types of trading opportunities that were discussed, which included energy prices. At about late March, I was beginning to evaluate this macro view, and it was at that point where oil prices have recovered to roughly pre-COVID levels. And then here were a couple of the narrative points that made sense. The first thing was that oil supply was really cut back after the crisis in 2020. There was massive pressure into the industry because of the green revolution, and because of that, investments and funding were shrinking. And there was the potential of a falling dollar as well, which didn't really play out as much, but a falling dollar would be a positive thing for commodity prices like oil. To trade this idea, I was looking into an ETF, which is a futures-based one, called DBC. I made a trade on April 12th because at that point I thought there was enough confirmation from the technicals where I saw prices reacting quite well to the moving averages, the RSI levels were great, and on top of that it looked like a potential breakout out of a trend line. Now this trade was on for a few months and I exited at around July 6th, and that's when it had a massive sell-off. The main thing I was paying attention to was the divergence in RSI that I was seeing. And again, like I said, during that day, there was a massive sell-off triggered by some news. So I took it as a sign that, hey, it's good enough for a trade and I'm comfortable making an exit here. Again, as a disclaimer, I don't really trade very often. So this ends up being, I think, one of the 4 or 5 trades that I made this year. So if you have any questions, just feel free to leave them in the comments below. Or if you happen to use any of the indicators that I use as well, but you use it differently, let me know. So thanks for watching, guys. I hope you all found this useful. And if you did, I'd appreciate your support in clicking that like, sub, and bell button. And I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.